What you are witnessing right now on your screen is not a normal dip. Brent Crude just printed a daily loss of $8.50, a 7.7% collapse, piercing the critical 102 handle and touching 96.75 in a single session. If you are long oil, this is the type of candle that liquidates entire month-long positions. If you are sitting in cash, this may be the exact kind of violent repricing that sets up the trade of the quarter. I am Eric from Alpha Market Meridian. I'm going to walk you through the chart frame by frame, connect the institution's flow, and by the end give you 3 precise strategies with numbers you can put directly on your platform. Stay with me. The trend status for Brent Crude right now is clear. We are in an accelerated daily bear move. This is not a sideways consolidation. This is an impulsive break that has invalidated the entire multi-month range between 110 and 105. The level that defines everything from here is 102.20. That's the daily MA20. Below it, the path of least resistance is down to the 9390 zone. Above it on a strong weekly close, and only then, we can start talking about stabilization. But right now, the momentum stack is entirely on the side of sellers. Let's start with the daily chart, because that's where the structural damage has been done. Look at the moving averages I'm highlighting. The daily MA5 at 109.25, MA10 at 107.68, MA20 at 102.03, MA50 at 98.74. Prices closed at 101.96, which means today's body is below every single one of them. This is what I call a waterfall alignment, short-term averages cutting below longer averages simultaneously. The MA20, which was this market's dynamic support for weeks, has turned into resistance. On top of that, the daily MACD has crossed below its signal line with expanding histogram bars in negative territory. I'm seeing a value of around -8 on the MACD histogram, accelerating, no bullish divergence yet. RSI on the daily has slumped to 39.86, and that's not even oversold, which tells me the momentum has room to continue lower before any mechanical bounce. Now zoom into the 4-hour chart. Here the picture is even more aggressive. We opened at 107.70, immediately stalled, and then liquidation cascades kicked in. The 4-hour MA20 is currently sloping down from 107.30, and MA60 from even higher. The distance between price and these moving averages, what I call the gravity gap, is so large that any pop towards 103104 is a high probability mean reversion entry for shorts, not a reversal buy. The 4-hour MACD is deeply sub-zero with no sign of rounding. On the 1-hour chart, we had a brief hold at 101.78, which is today's MA5, but the bounce lacked volume and was immediately sold. The intraday support is the session low at 96.75. Resistance is the broken psychological level of 100 now turned ceiling, then 107.70. The opened-at-watch key levels to burn into your screen immediate resistance zone. 102.20 to 104.00, confluence of MA20 and yesterday's breakdown point. Critical resistance far out, 107.70 to 109.00, today's open and high. Only a recovery above this would surprise the bear thesis. Major support, 96.75, today's low, and below that 93.00, a structural level from earlier this year, visible on the chart. If 93.00 breaks, the 7965 zone comes into play, which is the pre-war range from 2025. So why did we crash 7.7% in one session? There are 3 narratives converging. First, a sudden global demand shock. I'm seeing new composite PMI and industrial production fears out of both the Eurozone and China, and the market is pricing in forward recession risk. Second, institutional positioning. The commitment of traders report and early ETF flow data point to a massive unwinding of speculative length. When you get a large overhang of long positions, any break of the range triggers a liquidation cascade, and that's exactly the price action we saw from 109 down to 96.75. Third, the intermarket confirmation is screaming risk off. Look at S&P 500 futures. They correlated perfectly with crude's breakdown. Bitcoin, today, also retested critical support. Risk assets are moving in lockstep liquidation. At the same time, gold is holding up, confirming that this is a demand side, not a supply side, shock. When oil dives and gold stabilizes, the smart money is pricing in a recession, not a geopolitical supply disruption. That's your context. The specific trigger in the last 24 hours, although I can't attribute it to a single headline. Without the exact news, centers on the algorithmic reaction to the 110 support break. Once 110 gave way, the next technical trigger was the 107.70 area, which was the 50 level on some models, and algorithmic selling accelerated. Oil now is basically in a seller's market until the fundamental narrative shifts, which would require either a credible coordinated production cut, a dramatic rebound in global PMIs, or a geopolitical supply shock that overshadows the demand fear.my 1-2-week directional bias, bearish as long as price stays below 104.50 on a closing basis. I expect a test of the 93.00 area, possibly a brief capitulation wick into the high 80s, before any meaningful base building. The risk that would invalidate this bearish view is a sudden collapse in the US dollar index on the back of dovish Fed repricing, or a military event that physically disrupts supply. But right now, the path of least resistance is down. Please subscribe MY Channel 4 Trading Opportunities OF3 Strategies to trade today. This is the part where most YouTube channels give you a generic buy the dip or sell the rip. I'm going to give you 3 distinct frameworks, each with a specific trigger, invalidation point, and profit target. Pick the one that matches your risk tolerance. Strategy 1. Conservative fade the bounce short. This is for traders who want a high probability entry near the new resistance zone. We wait for a rally, not chase the breakdown. Entry trigger. A 4-hour candle close above 102.50 but failing to break 104.00, with a bearish engulfing pattern on the 1-hour chart. If that prints, you enter short at market with a stop loss at 105.20, just above the structural level and MA60 on the 4-hour. Target 1 is 98.50, midpoint of today's range, giving a risk-reward of about 1 minute and 2.5 seconds. Target 2 is 93.80, for a 1:4 plus RR. Invalidation. A 4-hour close above 105.20 flips the short-term structure bullish and we exit. This strategy thrives on the mean reversion to broken support now resistance principle. Strategy 2. Standard trend continuation short. This is the sell rally's bread and butter trade. Condition. Price enters the 101.50-102.20 zone, which is today's VWAP and the hourly MA10, and stochastics on the 15-minute chart produce a bearish cross below 80. Entry upon that cross. Stop loss at 103.00, above the psychological 100 recovery level that would squeeze shorts. Target 1 is 97.20, just above today's low to capture liquidity. Target 2 is 93.50. When target 1 is hit, move stop to break even. This setup respects the prevailing momentum and lets you ride the downtrend with a defined exit. The logic is simple. In a strong trend day, the first pullback to an intraday moving average is a gift. Strategy 3. Aggressive reversal scalp, high risk. This is only for experienced traders who understand that failed breakdowns produce violent snapbacks. If price makes a new low below 96.75 but then immediately recaptures above 97.50 on the 5-minute chart with a bullish engulfing accompanied by MACD histogram hook north, you can enter long for a counter-trend scalp. Stop loss strictly at 95.90, below the wick. Target is 100.00, the round number and today's midpoint. This trade offers a potential 2.5:1 reward, but the probability is lower, maybe 3.540%. Do not marry this trade. If 100 is hit, take profit and stand aside. If price falls back below 96.75 after entry, you exit immediately. This is a trap shorts play. The market has punished late sellers and can squeeze them hard. I will never stop repeating this. Any single trade must not risk more than 1 to 2% of your total trading capital. That means your position size is determined by your stop distance, not by your conviction. Also, Never hold through a major economic release unless you have a volatility cushion specifically accounted for. Stops are the oxygen of your account. Cut losses fast. Let winners a UN.to wrap up. Brent Crude is in a strong bearish breakout. The line in the sand is 104.50 on the upside and 93.00 on the downside. My base case is we drift lower into the mid-90s this week as momentum chases the breakdown. Tomorrow, watch for any unscheduled OPEC Plus comments. A head fake reversal could come from that corner. Also keep an eye on the US dollar index. A dollar rip would add further pressure, while a dollar drop could slow the oil bleed. Now I want to hear from you. Type in the comment section. Are you looking to fade the bounce at 102, hold for 93, or do you think this crash already overextended? Give me your battle lines. Smash that like if you're using these levels to trade, subscribe, and ring the notification bell so you never miss our daily 8 asset coverage. I'll see you in the next analysis. Trade smart.